Welcome to Markets Now. I'm Michelle Rook with Ellen Brugler of A&N Economics. And the livestock futures, well, we've seen a little two-sided trade, but firming as we get into the early part of this session. Grains are quietly mixed, maybe even a little bit lower. Ellen, I want to start off talking about kind of this tug of war that we seem to see in the grain trade. We get good demand, like we saw more flash sales this morning on both corn and soybeans, and then the market goes up, and then what, farmers sell against it. So are we going to get this back and forth for a while, you think?
Well, I think this is fairly typical for this time period. You've got a lot of grain flow, obviously, with harvest well along. Last night USDA told us that harvest progress was way ahead of normal in the 5-year averages for corn and beans. But the fund buying has been mostly short covering to this point. And, it's defensive rather than offensive. And they really are looking for that bull story that says, okay, prices are too cheap and we can bid into this. I can make some bullish arguments in terms of inflation. Certainly the bond market thinks there's an inflation play out there. I can make the argument that basis is strong, which tells you price is probably cheap on the board. But yeah, we're also dealing with a record crop and almost 17 billion bushels of corn total supply, a little under that, but that's a lot of corn to put in some place, whether it's exports or just storage for later. The market should be building a carry here to try to get you to store that large crop over time. But actually, the spreads have been pretty strong because of the export demand.
Yeah. So do you think then export business continues here, or what do you sense in terms of the demand side of things? Will that keep providing a support or a floor under this market?
I think demand is going to be pretty good at this price level. I made the comment a month or so ago that I wanted to see a rally because we were too cheap, but I didn't want to see too big of a rally because South America is still planting, and we didn't want to incentivize them to plant more corn and more beans. They're still looking for bigger crops in South America right now than they had last year. Weather is reasonable for this time period, but the key here, I think, is Brazil did have some crop problems last year. We've got a more favorable first quarter window than we did a year ago. So you're going to see some comparative sales are going to look pretty good. And you've also got that tariff situation in the background, potential tariff situation after the election. And I think that's got some of the global buyers kind of front loading their purchases. If I was the U.S., I'd be front loading purchases of rare earth metals is one thing. But the foreign buyers that depend on us for grain, I think are being pretty aggressive here just because of the uncertainty.
No doubt. So the tariff situation, you mentioned that, and really China must be concerned about that because they really are not wanting to buy any beans past January, right?
Yeah, normally, you'd expect them to slow down the volumes by January and then dribble, in February it's a dribble, and by March they're totally South America. I mean, that's the normal pattern. But yeah, it makes some sense that if you're going to have some kind of a tariff fight, that you want to front load your imports. What we know from the trade war back in 2018, 2019, they do need some imports from the United States. The global S&Ds just won't allow them to go 100% South American. There's always dislocation. I've argued that it's not the end of the world to have a China shut you off on beans, because ultimately you just shift those bean exports to countries that were buying Brazilian or Argentine and now have to buy U.S. But that lag effect, that 2 or 3 months while the market readjusts, tends to hurt you. The thing I remind everybody about on tariffs is a tariff is a tax, and it can be paid by the buyer or it can be paid by the seller. And what I mean there is If the Chinese economy is weak enough, they may accept a lower selling price on things that have a tariff on them in order to get the volumes to move and keep unemployment. If what everybody assumes is the case is that U.S. producers will just raise their prices and it'll be inflationary, and it's just a tax on the American consumer. And the last time around, most of it turned out that way. But again, the market does adapt, and I think there'll be some things that'll play out differently this time than last time. And certainly that'll be the case if Harris wins. It'll be more of the existing tariffs, I think, and less aggressive.
So you think we're kind of jumping to conclusions more negative than we need to about the tariff situation, but you also bring up China and their economy. Now they've thrown all this money, stimulus money and efforts at the economy. Is it not working? Is that kind of the signal that you're getting?
That's the perception, is that has not been as effective as they had hoped. You got a huge stock market rally in China when the stimulus packages were announced. I'm told that some of the stimulus packages really don't have any teeth behind them, or they haven't been fully implemented yet. So that's part of it. But you have to realize they had a tremendous housing crisis. I mean, worse than the 08-09 U.S. one in terms of surplus. In our case, it was finance. In their case, it's actually surplus properties that are built or half built. People were buying 2 and 3 or 4 apartments, intending to flip the rest of it. Well, now you've just got this huge pile of real estate sitting there, and it's going to take a long time to work that off. And I think the market got ahead of itself. They've got other complications just with the exports and with jobs. Long term, they've got a population problem, but that's not what's driving this situation here.
The other thing we need to talk about is, again, the third year of low water levels on the Mississippi River. How is this going to impact our export program, especially soybeans? Because we're in that vital time period. This is our time right now, isn't it?
Yeah, this is our time. This is when we got to get her done, as our Nebraska resident Larry, the cable guy, would say. You've got to get those volumes moved, because again, South America is going to be a viable supply option come the first of the year, or certainly not long after that. So this is not ideal. Fortunately, the Panama Canal is in a better condition than it was a year ago, so that's one thing that's different. But to the degree you've got the low water levels, what you're going to have is you got higher freight costs, because you've got smaller barge tows, or you can't load them as heavy. You've got to put more emphasis on rail. You've got to put more emphasis on the PNW if you're going to Asia. Rail is complicated. The nice thing about rail is we do have a lot of buying going to Mexico right now. Mexico's been a huge grain buyer, and that avoids the whole Mississippi River situation. It's the problem there is congestion on the rail lines in Mexico.
Yeah. So we've had a pretty good postseason rally in these grains. So is it done, do you think?
I think it's more of a, when does the next phase start? Okay, if you look at our average annual trading ranges for corn and beans, the corn, it's $1.52 per bushel. Beans, it's $3.04, if I remember right. We're still in the bottom 20% of those expected ranges based on what USDA's got for cash average price. That's not uncommon at harvest. I can say that the average right after harvest, or first rally off the harvest lows for corn, is about 40 cents, and we've done that. Okay, you had an early harvest low, you had the rally. So the market is kind of sitting there, and the spec funds are in the same boat, saying, okay, we got the easy money, we got that initial rally that we thought we were going to get into October or November. Where's the story for the next leg? Is it inflation? Is it crop problems in other countries? what's the ammunition for the next go?
Yeah, we don't really have a reason right now for the funds to go back and maybe go long in this market for sure. So let's talk about cattle. Live cattle futures this morning making new highs for the move, but we still have the December contract right up against that 190 level. Do we have to get above that for the funds to stay interested in this market or not?
I think we have some pretty stiff resistance between 190 and 191. You've got some sort of a triple top from last summer. Yeah, so we know this was a price that caused some problems before. Now, having said that, we still don't have a lot of beef supply, and to the degree that we want to hold heifers back for mama cows, we're going to have less, right? We're going to reduce at some point. We're going to reduce those feeder inventories because of retention. So, taking the long-term perspective, things are probably still going to get tighter before they get looser. Short term, we're aware there was a big sell-off last fall. The market's probably a little leery about adding length here just for seasonal purposes. But we have very tight ready numbers. That is, based on placement weights and average feeding time and so forth. Ready numbers are still pretty tight into the first part of November. They are going to go up seasonally into December. But the packer margins are fairly snug here on the cattle side. If they get more for the beef, that's pretty much going into the cash cattle. The one thing that I have noticed is that we're normally soft in September. You get past Labor Day, everybody's back in school. You do tend to have a seasonal slump there in beef interest, if you will. Now we're in a better hurry up mode because you're going to start competing with turkey as you get closer to Thanksgiving.
Yeah. So, and we do have a cattle on feed report coming up this week. Cash trade, as you mentioned, has been a very important part of this rally that we've had in cattle. I've got to ask you, so this McDonald's quarter pounder incident, they are pulling quarter pounders for the time being because of E. coli contamination, not to the beef, but to the onions that are on them. What impact will this have on the market, or are we trading through it?
Well, I think we're based on chart action. We're probably trading through it here. You're going to lose. Excuse me. You're going to lose some incremental beef consumption there, simply because of consumer perception. All right. Number one, they're pulling the product. The word's out. Hey, some people got sick eating quarter pounders. Don't eat a quarter pounder. It's not clear if that will, to what degree that'll impact McDonald's overall traffic. It's possible it might shift just a fraction of a percentage of consumption to chicken sandwiches for a while, or it may mean that, okay, everybody knows it was the quarter pounders. We'll just eat some other sandwich. But these things tend to have short-term impact on demand. But it's going to be mostly in your ground beef. Your 50 to 90 CLs, whatever particular mixes McDonald's use, but that's not what drives the cattle market and the carcass value overall. It's it's a piece of it certainly, but I think we're going to get past it fairly quickly as long as there's not another shoe to drop, another restaurant or two that has the same issue.
Very good. All right. Well, lots of moving parts in the market right now for sure. Thanks for joining us, Alan Brugler with A&N Economics, and that is Markets Now.